Hello everyone, and a warm welcome to this webinar. If anybody has any problems in regard to hearing me or my co-host speaking during the webinar, please just send us a message via the chat box, and we will see what we can do to fix it for you. So during today's webinar, my co-host Neville Hornsey and I will be walking you through how to locate the volatility and volume indicators on the new ActivTrader platform and how to successfully incorporate those in your trading or trading strategy. We will also be discussing the recent performance of the Aussie US dollar pair, the Australian economy, and the best way to trade other commodity related currencies as the economic slowdown currently underway in the Chinese economy gathers pace. So now I'd quickly like to introduce myself, and then I will pass you over to my colleague Neville, who will also give a brief introduction as well. So my name's Nathan Batchelor. I'm a foreign exchange trader with a background in hedge fund trading. I have over 10 years of experience, and you may have previously seen me in the popular market movers, the biggest market movers videos for ActivTrades. I also write a daily column for ActivTrades. If you go to the market analysis section of their website. So now I'd just like to pass you over to Neville.
Hello, my name is Neville Hornsey, and it says here I'm a macro intraday trader, which basically means I look at the news every day and I trade accordingly and then close out at the end of each trading session. Trading mainly the CFD majors and currently trading euro dollar. So back to you, Nathan.
Yeah, sure. So now I'd just like to quickly work through the topics on the agenda. So how to locate and use the volume indicator, volatility guidance on the ActivTrader platform. We're going to do a Aussie US dollar outlook and predictions, and also what the Chinese slowdown means for the Australian economy, and also we're going to be looking at various commodity related currencies, and we're going to be having a forecast on those as well. So now I'd just like to quickly bring up the risk disclaimer. Before we begin, please take a moment to familiarize yourself with that and read through it, and then we'll begin the webinar. Okay, so the first section now, we're going to be looking at the volume indicators on the new ActivTrader platform. So you can see there we've opened up the new ActivTrader platform, and if you go on there, you will go to the section that says volume indicators.
Hang on, I think this is frozen.
Sorry, they were just going to refresh the ActivTrader platform where we've been waiting for the webinar to start. I think it's frozen, so we're going to come back up and reboot it, and we will restart in a moment.
Typical. Yeah, still loading. Hang on. I would say talk amongst ourselves, but it's just us.
Yeah, so I will quickly run you through while Neville's sorting out the technical problems. I'm quickly going to be talking about the various volume indicators that the ActivTrader platform offers. We've got the Williams accumulation distribution, or the WAD indicator. We'll also be looking at the volume oscillator. We'll also be looking at actual volume itself, and also the volume rate of change. So Neville's now got the platform up and running. Yep. So now we've got the Williams accumulation distribution indicator. So I'm just going to briefly run you through the best ways to incorporate this indicator in your trading. So the Williams accumulation distribution indicator was created by Larry Williams, and the WAT indicator is traded on divergences in the market. So for example, when price is making a new high and the indicator fails to exceed its previous high, distribution is taking place. So we've got a clear price divergence there, and when price makes a new low, and the WAD indicator fails to make a new low, accumulation is occurring. So just to summarize there, how to locate trading signals. Traders would go long when there is bullish divergence between the Williams accumulation distribution indicator and price, and they would go short on bearish price divergence for the WAD indicator. So you can see there some clear examples in front of you for the Australian dollar. So now we're just going to take a look at the volume oscillator, and what I'm going to do, I'm going to run you through a brief introduction and the best ways to incorporate it. So the volume oscillator consists of two moving averages of volume, one fast and one slow. The fast volume moving average is then subtracted from the slow moving average, and the volume oscillator is often interpreted using the same principles as volume analysis, i.e. an increase or a decrease in volume accompanied by an increase in volume may be considered a sign of strength in the prevailing trend. Therefore, when using a fast volume moving average, typically traders will use a default period setting of 14. It is above the slow volume moving average, which is in the default setting typically of around 28. So the volume indicator is above the zero line and may be confirming the actual price direction, whether it be up or down. An increase or decrease in price accompanied by a decrease in volume may be considered a sign of weakness in the prevailing trend. Therefore, when the fast volume moving average is below the slow moving average, the volume oscillator is below the zero line, and it may be warning that price direction is lacking strength and conviction. So, you know, it's something that traders can easily incorporate into their trading. The volume oscillator can also be used as a diversion indicator, much like the WAD indicator, and divergences obviously occur when there is an increase or decrease in price, which is accompanied by a decrease in volume. So now I'm going to be talking about the third indicator, which is actually volume inside the ActivTrader platform volume section. So volume actually points to the amount that a financial instrument that is traded over a specific period of time. It can refer to shares or contracts or lots. The data is typically tracked and provided by market exchanges or brokerages. It is one of the oldest and most popular indicators, and is usually plotted in colored columns, green typically for up and red for down, with the moving average. It is one of the few indicators that is not based on price, so again it's very useful for traders. High volume points to high buying interest, obviously, in an instrument and its current price. A sudden increase in trading volume points to an increased probability of price changing. News events are typically moments when volume can increase, and obviously we see this around the non-farm payrolls job report, the ISM, and such like. Strong trending moves obviously go hand in hand with increased trading volume, can therefore be seen as a measure of strength in the market, particularly if we see this high volume remaining in place rather than just a brief spike. So typically traders would expect to buy high volume at a support level and high selling volume at a resistance level. There are obviously numerous ways to use in a trading strategy. For example, volume increases on a price decline, and then price moves higher, followed by a move back lower. If the price on the move back lower stays higher than the previous low and volume is diminished on the second decline, then this usually is interpreted as a bullish sign. So now I'm going to discuss the fourth indicator in the volume section, the volume rate of change. The volume rate of change indicator measures the rate of change in volume over the past a number of sessions. In other words, the VROC indicator measures the current volume by comparing it to the volume over the numbers of periods or sessions. The VROC indicator can be a powerful technical indicator. When the rate of change is high, you can then compare price to any technical support or resistance level, or use any other price-based technical indicators as well. In circumstances that the volume rate of change indicator can tell you ahead of time whether the support or resistance level can be breached and confirm the trend as well, the volume rate of trade indicator also measures volatility. When volume rises, there is more activity in the asset class, therefore you can expect higher volatility. Some traders use a 10-period setting, while others may prefer a 20-period setting for the VROC indicator. It's very much a personal decision for the traders to experiment with different settings for the VROC indicator. One should always take into account the fact that the volatility of a security can rise or stay flat over prolonged periods of time. Therefore, a day trader must take into account all these factors when deciding what period setting to use. Most commonly, the volume, a rate of change indicator, can be used to determine fake breakouts in the market when markets are trading at new highs and volume is low. So you can see there, it's a very interesting indicator to apply to your price charts. I think in summary, using volume incorporated with some type of divergence indicator such as the WAD indicator is probably the best way forward when incorporating these new volume indicators onto the price charts. So with that said, I'd like to pass over to Neville, and he's going to be discussing the volatility guidance on the platform.
Okay, let's get rid of some of this. Okay, so going into the indicator section on ActivTrader, at the very bottom, we've got the volatility section, and that contains the moving average envelope, linear regression forecast, linear regression intercept, and Bollinger Bands. I'm going to talk about the first one, which is moving average envelope, and it tracks a simple moving average. So if I get rid of the simple moving average there and open this, set to the close prices, you can change from simple to any other moving average that you can think of. We'll keep it on simple. A common simple moving average would be, say, the 20-day moving average, and you can see here that our bands upper and lower are equidistant from the central moving average. If I expand that percentage to 1%, you'll see that we capture pretty much 90% of all of the price action moves within the candles, and then every now and then we break out of the envelope, and that can signify a change in direction or a volatility spike on news. Obviously, if it's a volatility spike on news and we pop out like we did here and then start trading back within, that is a signal that maybe that move is done, and a reversal when you take out the volatility candle, such as here. Once you take out that high, this move below the envelopes is negated, and traders' stops will be taken, and then you'll see, well, you can see what happens next. We go higher. But I'll just erase this, go back to my pointer. Okay, so the way I used to use this was if we're in a range bound environment. So here, all the prices are captured within the moving average envelope. We've still got the annotations from the, what was it called, the WAD. We've got some accumulation going on. Here you see that we pop out, and then that is signifying to me with this indicator that this range has now been breached, and possibility of a new trend is ensuing, especially on something like the Aussie dollar. It tends to trend well. So for the daily price moves, if you get into a trend early, then you can stick with that trend for a long time. All right, let's just move this out. So yeah, essentially based on a moving average, you can change your time periods and your percentages to capture more or less. So maybe with a 4 hourly rather than the whole percentage deviation either side, maybe you could use 0.6. And here you get a few more false breakouts like so. So you'd have been, if you'd gone long there, you'd have been stopped out. If you've gone short here, maybe you'd been stopped out. But if you'd taken this one, you'd get all of that move just there. So yeah, that's how I used to use the moving average envelope as part of my strategy. Similarly, if we go to the bottom of the volatility, the Bollinger Bands, this is also a well-used indicator across many strategies. What we would normally suggest is to look for like a bow tie or a squeeze. All right, so let's go. Where's my range? Okay, here we go. Just going to get rid of all the other drawings. So when volatility is low, the Bollinger Bands come closer together. As you can see here, these were like expanding, and these are expanding. But in this particular area, the Bollinger Bands are quite tight in comparison. So when you spot a tightening or a range forming, any breakout can be seen as a positive move to the upside and a clear breakout of this range. So then I would be looking for a retest of those old highs within that range. Now, what part of your strategy could be to wait for a breakout and then a pullback to this central line, which is a moving average again. And you can change the periods of these averages by going into your cog. And here we've got a range of 20 periods and a standard deviation of 2%, well, 2. You can also add a second Bollinger Band, and with the same period, maybe tighten up those. And here we can change the colors so you can define it a bit easier. So yeah, you can see that if you use, say, 2 in conjunction with each other, you get these little mini ranges where a Bollinger Band squeeze happens, and then maybe a false breakout, but then a positive true breakout occurs here. And then you can trade back to the central moving average as your pullback and then go long again. So that's how I would use those. So essentially the Bollinger Bands and the moving average envelopes are excellent at showing when not an abnormal price move, but a larger, more volatile move has happened, and these out of the range moves can indicate a change in trend. So it's good to get in early or earlier and try and stick with these trends for as long as possible. If I just erase this and try and find a measurement tool, you could see that if you'd taken this signal here and only closed out when it crosses below the central thing, you'd have been in the trade for 7 days and could have possibly taken over 100 pips. So it's one way of doing a trend strategy. You got any questions on that, Nathan? Or
No, that's great. I think you've explained it really well there, Neville.
okay, so another thing I'd like to talk about in terms of volatility is linear regression. As something moves away in a sort of trending move, the idea is that it pulls back to the mean, and a lot of strategies will look for a pullback to the mean. This is great in a trending environment where you've got big moves up and then pullbacks, but to trade linear regression within a range takes a lot more agility. You can't be getting in and out too much because the costs will just weigh on your profits. But yeah, that's what I wanted to say on that. There's different strategies for trending and ranging, but I would only use personally the linear regression in a trending environment and taking signals from that then. So yeah, that's kind of what I wanted to say on that. Yeah, so back to you.
Yeah, sure. So now we're going to move to the Australian dollar against the US dollar, and I'll be giving my outlook and prediction, and I'll also be asking Neville for his thoughts as well. So I think the first thing to do when talking about the Australian dollar, obviously we're going to be looking at the technical aspects on the daily time frame, but I think it's before I do that, it's just probably prudent to just acknowledge what's actually going on with the Australian dollar at the moment. There's a lot of noise and there's a lot of buzz about the RBA potentially cutting interest rates as soon as August. We're seeing that the RBA haven't gone completely dovish with their policy language, although each meeting we've seen them actually turning slightly more bearish, whether it be their growth projections or it be their language towards the domestic economy. So that's the backdrop that we find ourselves in, and obviously the US dollar is gaining ground against basically all the other major currencies, and the Aussie US dollar is obviously no exception. So that's the background that we find ourselves in, and obviously technically we don't have any clear breakout at the moment, although we are trading towards the bottom of the 4-week trading range. So what I'd like to do is to draw a triangle pattern, if I may, on the daily time frame chart. If we can go to the daily time frame, and yeah, if we can go to the daily time frame, I'd just like to show you guys what I'm actually seeing. I'm seeing that we are currently trapped we have been trapped within this triangle pattern, and we're actually now starting to see a break below this triangle. So we've obviously seen that the market's tried to do this before, so I'd just like to alert traders' attention to this move that's currently underway, and I think it's worth watching it because we could start to see a weakness towards the 0.70 level. If that does start to occur, and obviously if we start to track below the 0.70 level, we could potentially start to test towards at least the low of last month, and potentially if we get underneath that, then you'll see that multi-year low that we'll be tracking back to as well. I'd now like to move to the weekly time frame chart, and we can see here that we have a bearish head and shoulders pattern, and the actual projection of this bearish head and shoulders pattern would take the Aussie towards a 0.56 level if it does play out. So obviously we need to keep our eyes on the neckline of this pattern, because if we do start to trade below that key trading low from many years back, if we start to take out the spike low, then we could potentially see the Aussie dollar coming under pressure for some 1,000 pips to the downside. So that is something that is worth noting. We're also trading below that key moving average, and we can see that pressure has definitely been building to the downside. So those are really the two main things that traders should alert themselves to. And I think on the daily time frame in particular, if we start to see price multiple daily closes below there, then that's definitely an interesting development. I'd also like to talk about the other side of the equation, which is the US and the upcoming non-farm payrolls report this Friday. The February jobs report posted the strongest gain in average hourly earnings in over 10 years. So if we start to see that is a new trend emerging, we could potentially see pick up an inflation, although it hasn't been occurring yet. But if we do start to see that average earnings are starting to gain pace, the US employer is willing to offer workers more money because the labour market is tightening. There's less skilled workers or workers available, then that's certainly a positive development inside the US economy, and we could certainly see some additional interest for the greenback, and this could obviously pressure this lower. So keep your eyes out, and obviously that trend line now is obviously acting as resistance in the short term. So potentially monitoring the trading action around there, sustained moves under multiple daily closes, and the catalyst could easily be the report coming out this Friday. So yeah, how about yourself, Neville? Any thoughts on the Aussie?
I don't trade it at the present, mainly because I'm just waiting for other geopolitical things to go on. But I would say that I would in the Aussie, I'd be waiting for China. So the trade deal between China and America, and if the dollar appreciates without a trade deal, then the Aussie definitely goes down a lot further. So it's yeah, I don't trade it currently, so not really any proper viewpoint on it.
Sure. Okay, that's great. So yeah, I mean that's the outlook that we've got at the moment, because obviously, even though we are seeing it trending lower, I mean obviously we can see the pair is creating bearish lower highs, but it's not creating lower lows. So again, another signal maybe if we start to see lower lows, but at the moment we can definitely see that bearish pressure is increasing. So this is definitely a currency pair that's on my watch list. So yeah, over to you, Neville.
Great. All right, let's go back to the slides. So the next slide is here what the Chinese slowdown means for the Australian economy is the title. I think a bit of backdrop first before we get into the Australian China economies. Globally, we've had quite a lot of things happen in the last few years. We had an interest rate hike cycle from the US starting at the end of 2015, beginning of 2016, and that recently came to a pause. We've had the inauguration of Donald Trump and his economic policies, including changes in tax reform. That's had an impact globally. And then his standpoint on Make America Great Again and what that means in terms of global trade, and how he has been going around the world, and especially with China, trying to hammer out a better deal for America. He wants to make America more of a manufacturing economy, whereas China has most recently been the manufacturer of world's produce. Really, it's the largest in that terms. So yeah, since 2018, quite a few things happened. We had US 10-year yields go above 3% and find a peak pretty much at the end of October, beginning of November. at 3.2, and then they fell off. At similar times, this global PMI, as you see, was trading above 54, and now it's been steadily going towards the 50. So for me, the correlation is quite clear that with interest rate hikes starting in 2015, 2016, and then pausing at the end of 2018, the US dollar yields going up, global PMI going up, everyone's feeling happy about themselves, and then it just got to a point where the dollar yields had gone too high, and the Fed freaked out as well as the rest of the market. So I think globally, the US dollar is the key. Having said that, recently, well, as of yesterday, hopefully it's not an April Fool's, Bloomberg reported that reported on the news that the Chinese manufacturing PMI had gone back above 50.5, well, to 50.5, so above the 50, and that signaled the biggest increase since 2012, and more importantly, it exceeded all estimates by the economists. As you can see, 2018 was a peak on the Chinese manufacturing PMI, and then as global PMI came down, China being the second largest economy, obviously as that was coming down, that was bringing global PMI down. And then the last couple of months, we found a bottom, and we've been trading under the 50 mark, so a non-expansionary environment for the last 3 months. But this month, well, for March, spiked back up quite dramatically. So taking out 1, 2, 3, 4, 5, 6, 7, seven readings. So that's why it exceeded the economists' expectations. But if China manufacturing PMI is on the rise, then that should be good globally. What we're still trying to work out, though, is the China-US tariffs, the trade war that has been going on. We're waiting for a deal which could be imminent, really. The news is that Donald Trump's team and the Chinese team are quite close, and they keep putting everything on pause. So hopefully that will be resolved. It was said yesterday that by one of the members of the People's Bank of China, he did make a warning that this latest reading of 50.5 could be a seasonality effect based on the Lunar New Year that they had back at the beginning of this year, as orders before and after that holiday, which essentially means China shuts down for a good period. There's normally a spike pre that as orders are made, and then another spike afterwards. So seasonality could be part of this new reading of 50.5. But it's to be seen. If the next reading is higher than 50, then global trade is all good. Talking of global trade, China imports less than it exports, but the countries that benefit from importing to China are South Korea, Japan, and the United States mainly. These guys do like 30% between themselves. With the US trade tariffs and that sort of a little trade war going on, the United States has started to lose out to Europe, and Europe has gained as China moves away from trading with the United States. So that's good for Europe, and Australia is kind of fifth in line, really. However, for Australia, China nearly makes 30% of total Australian exports, and those exports, as I put here, are iron ore, coal, and gold. If you look just below Japan has a similar, they import from Australia similar things, but they also take soft commodities like beef. Australia exports are heavily weighted towards the mining industry, and iron ore, slag and ash, minerals, and oils, distillation products, are far greater than the soft ones like meat and cereals. So an Australian economy is an export economy, and you need to be mindful that they're exporting a lot of mined goods. Here we can see that Australian exports from 2009 to 2013 steadily rose. And then in 2015, there was a bit of a slowdown. 2015, China had devalued its currency. Many reasons for doing that, but that might have had an impact on how China went around buying stuff. And then recently in 2017, exports to China rose again. In this slide, it shows almost the direct correlation between exporting to China from Australia and the Australian GDP. I don't think there's a clearer signifier of that. And not only do the Australians export iron, but they export coal. And that is probably because China is one of the largest countries in the world, and they are also the largest user of coal power stations, and they increasingly create more power plants as they try and fuel their steel economy. The iron ore from Australia, it gets exported to China. China converts that iron ore into steel, and China is the largest producer of steel. And I got down here that they have 10 times the steel making capacity of the United States, and they would use that steel for infrastructure. They've built cities, vast amounts of infrastructure there. Their car industry, their population's continually growing, continually getting richer. They're buying more cars. So steel is a massive part of that. So Australia needs to keep on supplying them with iron. If the demand for steel across the globe drops, then China, with its massive output, would flood the market with a lot of cheap steel, and that would lower international prices. But currently, I've got here that steel prices are on the up, and that's encouraged by a strong US domestic demand. They're still buying lots, and steel is going up also because of increased input costs, which is reflected in iron ore prices. I've also got here that if you want to monitor how well Australia's doing, you could go down to quite a micro level and look at a couple of companies that produce a lot of mined goods. So if we go back to ActivTrader, in ActivTrader, you can monitor not only foreign exchange, but you could also look for mining companies such as Rio Tinto. So it's under the ticker RIO spot UK. And here we have a chart for that. Okay, so on a weekly chart, you can see that recently Rio Tinto, one of the largest producers of mined goods in Australia, has been doing quite well for itself, making new highs well, multi-year highs. So the mining industry is good, especially if you're in Rio Tinto. You can trade Rio Tinto not only here, but on the London Stock Exchange, the Australian Stock Exchange, ASX, and the NYSE. You'll find Rio Tinto as part of the FTSE 100 as well. So a large company. So a good bellwether signal on how well the mining industry is doing. So what I was going to say, let's go back to the slides. Oh yeah, so with global economies, currently we are using more energy each year. The global energy demand shot up in 2018. Interestingly, I wasn't aware of this until doing the research for this webinar, but coal isn't that larger factor in global energy, even though China uses so much of it. Renewables and gas is a large proportion of global energy supply. The US and China quite obviously are the largest economies, and they do use the most energy. But it would make sense that the Australians, with all their sun, would go towards solar renewables, and so I would see that as being a future trade, and yeah, to keep an eye out on those sort of developments. And then the next one is Australian business confidence is currently at 0. Now, if Australia is an export economy and there's been a slowdown since 2018, you can see here quite clearly that there was a rise from 2016 up to the peaks of reading of 12, and now we're coming down as global confidence tracks the PMIs, as I showed earlier in the slides, and we're at 0 for Australia currently. I feel that if the trade deals between the US and China are resolved, global output will pick up, and then the Australian economy will obviously gain on that. You'll see the Aussie dollar rise, hopefully, and I think, yeah, this could be a turning point. Well, it's a wait and see at the moment. Everything's on hold while we wait for the trade talks to play out. But yeah, this is a good point to put Aussie dollar on your watch list, as Nathan said earlier. They are struggling with a couple of other things, which also include a housing bubble that has recently burst. You might have been reading in the papers that between 2016 2017, as everything was rising, the house prices in Sydney and Melbourne, were surging like at 20% year on year. And then 2018 comes around, global confidence starts to wane, and that bubble bursts, and Sydney house prices dropped almost 10% across the year. So in terms of Australian business confidence, that might have a double impact on them, but I'm sure it does, as businesses are on hold because maybe consumers aren't buying as much as they wait to see if their house prices are going to recover. Over quite a long period of time, the Australian government and banks were trying to work out ways of easing this bubble. There's a lot of migration, a lot of Chinese investment into Australian property. If you look at a map of Australia, you'll see that the urbanization isn't in the middle. It's just concentrated to little pockets on the coast, and there's quite a restricted amount of building you can do in those areas now. So house prices and demand correlated, and there was more demand than there was houses, well, properties. So that went up. The banks were lending even if the RBA had asked them to reduce the amount of loans to foreign investment. And then there was a change in global policy where the US dollar was being repatriated back to America due to the tax regime changing, on Donald Trump's wishes. He got American dollars to come back to America, and there was a bit of a credit squeeze globally, but in Australia, that could have had an impact on the loans that were being made, and obviously signified the peak in Australian house prices as well. So there's a lot of things going on, and I think the Australian economy is a positive one. It's an export, it's got a positive trade balance. It just needs global confidence to come back, and with that, China to start buying more of its exports. So yeah, that's kind of how I see China affecting Australia. Any questions, Nathan? Did I miss anything?
No, that's great. I think that's a brilliant assessment, Neville. I appreciate we're running out of time, everybody, so I'm going to quickly move to the last segment of the webinar, trading commodity-related currencies. So today we're going to be looking at the US dollar against the CAD, and also the New Zealand dollar against the US dollar. So first of all, we're going to start with the New Zealand dollar. I mean, obviously, we've seen the Reserve Bank of New Zealand last week, major dovish shift for them, and we've seen the Kiwi coming under pressure. Currently, I have 0.6740 as the line in the sand for this currency. At the moment, you're looking at a daily chart, and you can see the trend line there that's been holding up, very, very well since September of 2018. So we can see we're testing that now, and you'll observe that you've got 4 lower highs and 4 higher lows on there. So we are definitely after a period of consolidation. I think we're at a period now where we're going to start to break, I believe, downwards on this currency pair. So we can see, you've got the rising trend line there. If we start to break below there, similarly to the Australian dollar, I'd like to see this one come lower. So we are potentially going to move for a test of the 0.6740 level. Underneath this level, key areas of support that I've identified, you've got the 0.6685, which is a crucial long-term level, and below there you've got the 0.6590 area. I believe that's a crucial breakout level. If we go underneath there, we can easily test towards the worst levels of 2018. So this is something to watch as it might start to unravel. It'll be interesting as well if we get a Brexit no deal to see if traders move out of sterling and what type of currencies they move in. But obviously that can go either way. If we see an extension of Brexit, we might see sterling receiving a boost. So that's potentially not a reliable indicator at this time. But I'm flagging these commodity related currencies against the US dollar because I believe we are going to have a strong move out on the dollar as well. So these currency pairs could potentially yield some quite healthy pips to the downside if they do break down. Next, I'd like to have a look at the US dollar against the Canadian dollar. This is something that had looked very bullish with rising oil prices, but what we've seen is a deterioration in Canadian data, and we've obviously seen the Bank of Canada pushing back expectations of a further series of rate hikes this year. So we've seen the CAD coming under pressure, but crucially, we're not able to break above that key high there. We've been stalling, and we've now got a triple top pattern formation in play. So if I was looking to play a breakdown in this pair, I'd look for weakness below the pivotal level here that I've highlighted is a 132.60 level. If we start to get weakness below there, sustained weakness on a multi-day and a multi-week basis, there's a potential that this could start to come under pressure, but there's a lot of other risk factors hinging on that. But at the moment, I think it's best to go along with the prevailing trend, so bullish above 0.3260. Anything underneath that, we can have a look for some weakness. Key resistance areas to look out for, the 134.65 and the 136.60 area. To the downside, keep your eyes out for the 130-100 level and the 128.60 level. It's obviously quite some ways off, but if that starts to break down, a technical meltdown is likely to follow if we get persistent weakness below that 128.60. But at the moment, the pivot's 132.60, so it is an interesting pair. I wouldn't like to play it to the long side. The downside interests me because I think it has the greater potential to move lower. But then again, if we're expecting a stronger US dollar, then I think it's better just to stick with the prevailing trend above the 32.60 level until that happens. At extended targets reach all the way out to 137.40, all the way up to the 140 region. Anything your side, Neville, that you're seeing interesting on this pair?
Yeah, but I just want to refer back to the previous webinar where I actually did quite well at my predictions. Unfortunately, there was a spike in between. But yeah, I think for me, dollar CAD is easier to trade than the New Zealand dollar because of the correlation between dollar CAD and oil. So I've been looking at oil and I think 65 is a good target, maybe a bit of a ceiling. And we're not there yet. We're it's about 62. So if I think oil is going up, I think CAD's going up because they're like highly correlated. So I also think dollar CAD's coming down. And similarly to like how I said about the euro dollar coming down, which it did, I am personally looking at, let's get a drawing tool. All right, so this low, I think it's just ultimately where I want it to go. But realistically, I think we pause, around here first. Just going through like how that move was. If this is a double top at the top here, I'll just use the point pen. If that's a double top, and then we take out that low here, then the next sort of roadblock is this area here. And then if we do take out that trend line, then I don't see a lot being able to, we'll probably get a move up like that and then back down again. That'd be ideal. Look at that for a little smiley face. That'd be my ideal situation. If it's anything like my prediction on euro dollar, it'll probably do that first, stop me out, and then do that. But that's obviously possible as well. If people have got their stops up here, then that could happen, and that would happen if there was like you said, a strong dollar reaction to a good trade tariff result between them and China. You could take out the liquidity above the double top and then come down. So at the moment I can't trade it because it's in between this low and those highs. It needs to like break out and come down or go up and do that.
Sure.
So I would track US dollar China tariff trade wars, and I would track oil, and the first one to make a positive move would be how I would play the dollar CAD. That's how I would do it.
Great, thanks Nev, that's great. So everyone, thank you very much for attending this webinar. On behalf of Neville and myself, please join us at our next webinar where we will be discussing charting instruments and the channel. Please feel free to ask any questions in the questions section of the toolbox.
I've got a question. When's the next webinar?
The next webinar is on charting instruments and the channel. Please go to the ActivTrades website, and you will see the exact date and the exact time on there under the webinar section.
Cool.
Okay, so we don't appear to have any questions. Thank you everyone for joining this webinar, and we look forward to seeing you next time.